So when you say North Carolina, what are the markets you're liking right now in North Carolina? Where are you at? Where are you looking to be?
Yeah, so definitely like the Charlotte MSA, following that I-85 corridor through Greensboro, Winston-Salem, the Raleigh-Durham area, the Research Triangle, and then kind of bouncing out to Greenville, North Carolina, which is on the east side of the state there. So really enjoy those areas. You're directly outside of Charlotte, I should say, like the Concord, the Hickory, that is pricing makes sense still. Where sometimes in that Charlotte MSA it doesn't make sense. So again, happy to talk all about that, but all the areas that a lot of people that are in the southeast in North Carolina specifically are looking. So there certainly is a lot of competition in those spaces.
Yeah, and when you analyze a property, right? Give me what do you think percentage wise of the you get your eyes on the deal, you get your eyes on paper. How many are you underwriting, and then how many do you think land to make it to the next level? Is it 1%, 5%, 10%? How many of those are you looking at a day or a week?
Yeah, definitely. So, great question. I actually have a tracker that tracks all this that we're looking at. So, really, before we even look at the deal, we look at the market. So, if a broker sends us the deal, we're going to look at that immediate smaller market, that smaller, township, the MSA. And if it doesn't have growth over the last decade, and especially the last year, positive population growth, we can just throw the deal right off the table. But once it does, we start looking at the numbers. We actually start underwriting. We'll probably look at anywhere from 80 to 100 deals before we actually do one deal, and not offer on one deal. That's actually get a contract accepted and execute and close on one deal. So I'd say out of every 100 deals, literally one or two we're actually doing out of all the deals. And those are deals that we're actually looking at, underwriting, pulling comps on, and going through the motions with.
How much of your deal flow would you say comes from brokers versus, let's say, you pulling up, some type of GIS mapping system and cold calling landowners?
Almost 100% of our leads come from brokers, and that's because they're doing this all day. This is what they specialize in, is building relationships, finding deals, adding value to individuals that will eventually want to sell with them. And we know how much time, money, and effort they spend in their teams, and we don't really want to step into that arena because we'll have to put the same resources and effort in place to even match what they're doing or even get our toe in the water. So brokers are definitely bringing us the deals. Now that we have a good track record in that market that we close, we're doing multiple deals and we're doing a great job with our deals. And we don't retrade any of that stuff. We're getting a lot more off market deals. So that's definitely increasing our deal flow, where a lot of newer investors right now may not be seeing deals. The brokers are bringing them directly to us, and that's why.
When you are looking and comparing, let's say, an on market versus off market, is the value of the off market typically the sales price? Is it the fees associated with getting the deal closed? Where do you see that differentiation really come in when we talk about on versus off market?
Yeah, definitely. Great question. So today we closed on a 44 unit right outside of Charlotte today, and that was 100% off market. And the reason why we really found value in that deal was because of the price. This building, 1982, 44 units, we bought at 89,000 a door, versus literally a block away, an on-market asset that was 10 years older, so 1972, same exact type of building, sold for 130,000 a door. So right away, value as to what we're purchasing and where the rents are in both buildings, we feel that our price and our basis that we're going into is very safe and very comfortable. And that's because there's not as many eyes on it. So, the broker that we've closed the deal with before brought it to two groups. We were one of those two groups. We actually came in lower than the other group, but we had more experience with that broker and in that market, and they felt very comfortable just giving us that deal to make it a nice, clean, easy deal, because the seller was also very skittish. Their only asset, they've never sold before, they don't know how it works, they didn't want it marketed, they didn't want to scare the tenants or the property manager. So we were able to we actually did a 28-day close, raised the capital, got the debt, everything in 28 days, which is, it's not unheard of. It definitely happens, but it's not very common.
I would call it impressive at a 28-day close, from under contract to getting the thing done. I think a lot of people who want to be in real estate now, which I'm sure in multiple markets you're in, you've seen, there's definitely been an upward trend of just generally people who think, okay, it's time, I want to get into real estate. And so multifamily, I think, is kind of that, from a development world of municipalities, it's almost frowned upon because, hey, you're just bringing density. But from an investor perspective, it's kind of that golden child, right? Of, hey, this is cash flow. This is, people have to have somewhere to live. I want multifamily deals. And so as you've progressed through your experiences, what do you think has been the biggest learning lesson you've had thus far?
Definitely going bigger, faster, and getting larger assets. So when I say larger, I'm talking like, 40, 50 units and greater, because that smaller stuff is very difficult to manage. We bought a 24 unit early on, and it was more difficult to manage. We actually had to switch out the property management company because we couldn't have on-site staff. And that's something we didn't know. You don't know until you know, essentially. And when we learned that you didn't have on-site staff, you had one person that was managing it, but they're also managing 10 other communities that are 24 units. You're not getting all that specialty, that attention, the reports you need versus our slightly larger assets. We have property management, there's leasing offices. We get a lot more attention, and that's going to help us run the property much better. Collections are going to be better, and where there's a better line of communication as well, because there's a lot more focus on that singular asset.
Now, when you say on-site management, do you bring in a third-party manager, or do you guys hire on your own payroll for your managers?
Yeah, so we're definitely bringing on third-party property management. So it's a third-party team that has the systems, the processes in place, has the teams, and where we don't quite have that yet. We'd like to, especially once we get enough unit density in one area where we can bring on our own payroll, our own staff. We have complete control. We treat our property managers like employees, but this way, when we have that payroll staff, it can be our true employees. We run the show, and keeping things in house will also make it a little bit more cost effective, if you would.